Hello again, this is Terry Price, and welcome to the next chapter in our series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. I hope you enjoy. Welcome to the 9th chapter in our series covering the changes enacted by the Tax Cuts and Jobs Act. This chapter will review the new tax rates. The new law overhauled all the tax brackets and rates for 2018. In 2017, the tax rates range from 10% up to 39.6%. Although the beginning rate is the same for 2018, the maximum rate has been reduced to 37%. As you can see, the percentage rate was reduced at most all the different brackets. To see how this may calculate out, here's a diagram that shows the different tax calculations at some different levels. As you can see, the new tax rates for taxable incomes over $18,650 result in a reduction of income tax. Naturally, the higher the income, the more savings due to the reduction in percentages. One topic that has been discussed for several years is what is called the marriage penalty. In the old tax rates, once a couple has reached $153,100 in taxable income, they would calculate more in taxes than if they filed single. They were basically penalized for filing married. Thus, the name. The new tax rates for 2018 has eliminated the marriage penalty. So now, the marriage tax brackets are double the single brackets, which eliminate the penalty. There has not been a lot of change in the capital gain rates. They are still set at 0%, 15%, and then 20%. The brackets are pretty much the same as they were before, with a small adjustment for inflation. These rates are also what is used for qualified dividends. The new law made some changes to what is called the Kiddie tax. The Kiddie tax was enacted to prevent families from moving investment income to the child's name to be taxed on the child's tax return, thus at a lower tax rate. The previous law indicated that if a child under the age of 19, or 24 if a full-time student, has unearned income, such as investment income, in excess of $2,100, this would have been taxed at the maximum tax rate from the parent. The new law states that the income will now be taxed using the trust or estate tax rates, which has a maximum rate of 40%. The law still allows the parents to just include the income on their own personal tax return. And with the new maximum rate of only 37%, it seems it would make more sense to do this. Let's look at the mileage rates. For 2018, the business mileage rate is 54.5 cents per mile. Medical and moving expense mileage is 18 cents per mile, and charitable mileage is 14 cents per mile. Now, as a reminder, starting in 2018, business mileage can only be deducted on a business return, and moving expense mileage can only be used by members of the armed services. The IRS has released the rates for 2019. The mileage rate has increased to 58 cents per mile for business mileage and 20 cents per mile for medical and moving expenses. Contribution mileage rate remains the same. Thank you for watching this chapter covering the new tax rates. We greatly appreciate your time. Next time, join us and we will cover estate and gift taxes. Thank you and see you then. For more of this video series covering the Tax Cuts and Jobs Act of 2017, be sure to follow us on Facebook. You can find us using @TerryLPrice CPA. For previous chapters of the series, go to www.terrylprice.com/CPA and click on videos. There you will find all the previous videos. If you have questions, please email us at cpa@terrylprice.com. Please do not post tax questions as a Facebook comment. This video series is to provide some basic information concerning the recent changes in the tax laws. This is not to be considered tax advice. Please consult your tax preparer to analyze your individual tax situation. Thanks for watching.